Good morning, ladies and gentlemen. So today what we're going to be focusing on is really how the economy of the 1920s is going to kind of lead into the Great Depression, which follows, in the late 1920s, all the way throughout the 1930s. So we're kind of transitioning into a new time period in the class called the Great Depression. So really, what we talked about with the 20s economy, the things that are going on are really linked to why the Great Depression happened. So one thing that I want you guys to keep in mind, a lot of people look at the stock market crash of 1929 as the cause of the Great Depression. We're going to look at it a little bit differently. The stock market crash of 1929 is actually um, kind of like a symptom of problems that are developing all the way throughout the 1920s. So in a lot of ways, it's more of an effect of the issues going on in the 20s than it is the cause of the Great Depression. Now, we're going to go kind of one by one with different problems the 20s economy is facing. So one of the first big problems, if you look here on your map, the 1920s sees a huge gap between your top 1% and your bottom 90%, and also your top 10% and your bottom 90% of Americans. There's a growing gap, an unequal distribution of wealth in the society. And so this really has to do a lot with government policies of the time period, and we talked about uh, tax cuts for the wealthy and different ideologies that are kind of being put out there. So why this is an issue for the economy, if the wealth is not being distributed, at least not, it doesn't have to be evenly, but in kind of a more uniform fashion, middle class and lower class Americans can't contribute to the economy in the way that they should. And so it kind of shows great disparity within the American system and really kind of unequal distribution of wealth. The second big problem, which is related to the first problem, because of the government policies of the time period, they're relying on business owners. If you remember the philosophy with the Mellon's philosophy that we talked about, they're relying on business owners after they get these tax cuts to kind of reinvigorate the economy, grow the economy, which does happen. So the economy is growing to a certain extent. But they're also relying on these business owners to kind of transfer that wealth down to working class Americans through wage increases. Now, if you look here, you can take, this is just showing you different months. I would compare 1920 to 1925. And if you could look at any of these months, in certain months, it actually goes down, like wages go down. In other months, wages go up slightly. So what this is showing you over the 5-year time period is really that overall wages are basically staying stagnant. If you look at the bottom, this is kind of the best indicator. $1,188 is the annual income in 1920, and then if you look at 1930, $1,241. That's a statistically insignificant rise in wages. It basically means that throughout the 20s, wages stayed stagnant. Now, when you have to think about this, why is this a problem? Well, one of the things we've talked about in the class before is that every year, America basically averages about 2 to 3% inflation, meaning that your money becomes about 2 to 3% less valuable each year that passes. So if your wages stay stagnant, but things become more expensive, and your money that you saved is not as valuable as it was in 1920 versus 1930, what basically ends up happening is your purchasing power as a worker really declines. And this is a major problem for people who are going out and they want a consumer-driven economy. This is going to really hurt a consumer-driven economy. The same thing is true because people are buying things on credit and going into debt. And so if your wages are stagnant, you can't keep up with the inflation, you can't keep up with your interest payments. And so this again is another major problem for the economy. So like I said before, the average American, these two things are related. Their purchasing power is declining over time. So I really want you to think about this and make sure that you understand this idea. If their wages are not getting any higher, it's not that their purchasing power is staying the same. It's actually that their purchasing power is getting less because things are becoming more expensive every year. You may not notice it yet, but probably by the time you're, let's say, 30 years old, you'll think back to this time when you're 15, 16 years old, and you'll say, uh, a bottle of soda cost this when I was 16, now it costs 25 cents more. Just by comparing basic things, you can see kind of the inflation in society. Talk to your parents, talk to your grandparents, see what things cost when they were 15, 16 years old, and, how much more they cost now. Uh, it's due to inflation. Basically, the American economy allows for about 2 to 3% inflation every year. So if your wages don't keep up with inflation, your purchasing power declines. And like we said, if it's a consumer-driven economy, this is a major problem. Okay, now at the same time, what's happening is that even though the purchasing power and the ability to buy things for the average American is declining, companies are still producing tons of materials. So you have all these innovations in industry which are great for production, but what ends up happening is that companies are overproducing, and if you don't have markets to or people to buy these things and markets for these goods, uh, then really you're at a loss. You're stuck with huge inventory, and companies are going to start to take losses because they can't sell off all of their inventory. So on the surface, they're not laying people off. They're still producing, massive amounts of goods. So it looks good on the surface, but in reality, the company is starting to lose money. And if they can't sell their excess products, then eventually that company is going to go under. They're going to have to start laying people off, and their company is really going to start to decline. And so you're going to see this after the stock market crash of 1929. Another big issue is the oligopolies that we talked about. So this is more of a modern example of, I'm not sure if you guys ever realized this, but like TV stations. Um, if you look at TV stations, it seems like there's all these different TV stations, and you guys live in an era where there's 150, 160 different channels at a minimum. Some people have more, 300 channels. In reality, they're all really controlled by a couple of big companies. So this is similar to the oligopoly system of the 1920s, like when we looked at the car industry, where you have a few major car companies that dominate these industries. Now, when class we talked about it, and we kind of really, I think, as a class, came to a consensus that we thought this is okay, this is not necessarily a bad thing. That they have competition is going to strive and push them to create better products. There is a downside to kind of the oligopoly, I don't want to call it a system, but development in the society. And the downside to it is that if these few companies dominate the industry, and if they are overproducing, and if their companies do fail, they're taking basically an entire industry with them. And so you'll see this happen in certain American industries where they can't rebound, and there's only a few companies, and there's huge companies that employ tons of Americans. And so when they fail, it puts tons of people out of work, and it might destroy or almost destroy entire industries within the country. The next big thing, I don't want you guys to focus on this part of it yet, on the crash, but on kind of like the peak here of stock prices. So this is showing you basically just like overall stock market rise. So if you look throughout the 20s, stocks are rising tremendously for a couple of reasons. So one of the things that's going on here is people are starting to invest in stocks. So something that you may or may not know, the reason that stocks go up, two reasons that stocks go up. One, in the real world, the company is doing well and the company is gaining more value and more wealth. So that causes the price of the stock to go up. Second thing is that the more people that want to buy this stock, the higher the price goes up. Think of it kind of like a very scarce item that people want to buy at a store, like a new phone or something like that. The more demand there is, the higher the price can be. And so that's what happens to a lot of these stocks. They rise so high not because of the value of the actual company itself. They rise super high because of the demand for people wanting to buy the stocks. Because people feel like they buy the stocks, they can make money, it's going to go up. And so what happens here, as we talked about this in class, is kind of like a bubble effect. these stocks are overvalued. They're valued at a much higher price on the stock market than their actual worth would really be based off of the value of their companies. The second big problem with the way that stocks are being artificially inflated is something called buying on margin. What's happening here is that people who want to invest in the stocks don't necessarily have the money to invest in these stocks. Let's say a stock was selling for $10 a share, and you want to buy 100 shares of the stock. If you don't have the money, stockbrokers of the time period wouldn't turn you away. What they'd allow you to do is to do something called buying on margin. And they allowed as little as 10% and 5% purchases on margin, meaning if you wanted to buy a stock for $10, you only had to put down 10% of the money, meaning you only had to put down $1 of the money to get that one share of stock. Again, what this does is it artificially increases the price of the stocks, making them seem much more valuable and making their companies seem much more valuable than they really are. Okay, now this tariff wars that are happening, this I think directly impacts what's going on with overproduction. What's happening here is that America is trying to protect its own industry, and what we're going to do is we're going to pass these tariffs. So the most famous one is the Smoot-Hartley tariff, which is actually passed after the Great Depression begins and the stock market crashes because they're trying to protect American industry. But this is going on before the late 1929 and the early 1930s. Basically, what happens here, though, is that America starts increasing our tariffs on foreign products, European industrial products. In response, what Europe does is they increase their tariffs on American products. So we increase our tariffs more on European products. They increase their tariffs more on American products. Now, the long-term effect of this is that we don't do much overseas trading with Europe, and we don't get to export a lot of our industrial products. And so we have this excess of products that our own consumers don't have the purchasing power to buy, but might be able to export this stuff to European markets or other foreign markets. But our tariff policy is kind of hurting our ability to export our products, which kind of exacerbates the problem here with the cause of the Great Depression. The last one we talked about in class is deregulation of American industry. Allows American industry to kind of cut corners and be more corrupt and take advantage of kind of less oversight, which facilitates kind of long-term problems within the economy that might have been caught had government been regulating and watching industry more closely. Is really not caught during the time period. And this goes back to our Republican presidents that we talked about during the time period who are advocating for deregulation and advocating for kind of allowing business to regulate itself because they think that's the most efficient way for businesses to run. Now, all these problems in the 20s, underlying problems, are what's going to lead to the stock market crash of 1929. So what you're looking at here, this is your big day as far as like crashes are concerned. There's two major days that you want to keep in mind. You have what's called Black Thursday and Black Tuesday. Okay, so Black Thursday happens the week prior. And what happens on this day is that the stocks take, a sharp decline. Now, what happens next is that they come back up. So on Monday, they start to rebound. But then they kind of plummet again. So you have, this is Black Thursday right here, decline. It goes up a little bit and then kind of like falls right off the cliff. So this is Black Tuesday. This decline right here that you see on the graph is Black Tuesday. So that's in September of 1929, major stock market crash. Now, we'll talk about the effects on Americans more on Monday in class, but what happens here is that people who had money in these stocks, which is mostly upper class and maybe upper middle class Americans, some might have lost their entire life savings in a day. There's no safety net features to stop what's known as panic selling. really what happens here to understand the stock market crash, uh, people are in the stock market to make money. And so you make money by the stocks increasing in value. So like we said before, stock prices go up because of higher demand. So the more people want to buy the stock, that's going to raise the value and raise the price of the stock. The opposite is also true. If people start selling, it starts to make the price of the stock go down. If people and think about the ramifications for that. The more the price of the stock goes down, the more people who have money in the stock want to sell it. Okay, and so as it kind of creates like a runaway train effect. The price starts to go down, people start to sell a little bit. The price goes down more people start to sell. And as the price starts to keep going down, people start panicking because they want to try and sell the stock before they kind of lose what they invested in the stock. They don't want to lose everything, and they don't want to lose their entire investment. And so they start to what's called panic selling. Now, this can happen with one stock. um, it becomes a stock market crash when it happens like in many areas with many different stocks. And that's what happens here in the stock market. You have this massive panic selling developing in the stock market. Now, after Black Thursday, it's kind of interesting when you look at the headlines. People are not necessarily um, thinking that this is going to be, the last, or this is going to be like a huge crushing blow to the stock market. A lot of people feel that it's going to bounce back, that it's going to come back. Now, we know that that's not the case, that it takes years. It takes about 10, 15 years. It takes World War II to kind of pull us back out of this Great Depression. But that's kind of like the thought of the time period. So in class on Monday, what we're going to do is we're going to really look at the effects of these underlying problems that are going on during the Great Depression, and we're going to look at, really kind of long-term and short-term effects of the stock market crash and the Great Depression. So I'll see you guys on Monday.